Jonathan, thank you so much for joining us today. I have long awaited this interview because we work with you guys and we love working with you guys on all of our syndications. But first, why don't you tell us a little bit about you?
Well, thanks so much for the kind words, Stephanie. I appreciate it. I'm Jonathan Tavares, the managing partner of Premier Law Group. We focus on helping our clients raise capital to form syndications and funds, primarily in the real estate space. I have been with Premier the last 4 years, but my background comes by way of real estate. I've been involved in the real estate industry for 15 years, so that's the perspective that I take when talking to clients about setting up their own syndications or funds, debt funds, private equity funds, all sorts of different arrangements in the real estate space.
Yes, and I appreciate how detailed you guys are and how on point and how responsive you guys are. You're extremely professional, and I love sharing all of the vendors that we work with because hopefully other people can benefit from working with the people we think are the best. So let's start maybe with a little state of the market today, if you don't mind. What are the IRRs looking like? Are you seeing more or less deals come across your desk? And then maybe we can jump into the structure of how a syndication and a fund works, if you don't mind.
Yeah, absolutely. Yeah. So we can jump right into the state of the market. So generally what we've been seeing, I would say probably the last 6 to 8 months is more of a shift to funds. So traditionally, especially during COVID, a lot of clients were doing a lot of multifamily syndication. Now, granted, that's been a piece that we've focused on for a long time. A lot of our clients are heavily involved in the multifamily space, but obviously with increasing interest rates over 22 and various other factors, property taxes, throughout many counties and throughout the country going up very quickly, as well as insurance and specific markets as well. Like we have a lot of clients in various markets in Texas that have just gone crazy, places like Houston or in Florida, right, where insurance rates have skyrocketed. It's presented some challenges for some of our clients. And so we've seen a lot more creativity in terms of the types of deals that our clients have been putting together. So instead of seeing just a straight deal with a certain percentage of equity or rather debt, somewhere around 70, 80%. A lot of times there's a lot of creative financing going on to make up for that debt piece that may not be there or where those percentages of debt to purchase price may be a little bit lower than what a lot of clients were used to before. We've seen a lot of preferred equity. We've seen clients building out structures where, in essence, they're providing almost a debt structure to their investors too, to create sort of a debt piece as well as an equity piece in their raises. And so we've seen a lot of creativity there. We've seen a lot of clients create funds and use their funds to come in for part of the debt piece for specific projects as well. So a lot of creativity in that space. You also asked about preferred return. So typically, I would say for most deals, depending on the asset type, and I'll specifically exclude development projects, we're seeing a lot of target IRRs between 15 and 20% generally in the market.
That's fantastic. Uh, so if you don't mind, let's review the structure of a deal from syndication's perspective to make sure that, where do all the LLCs go so that everyone is protected as much as they can possibly be.
Yeah, well, as you're probably aware, there's all sorts of different structures that you might use to set up a syndication or a fund, and for different reasons, for tax reasons, for asset protection reasons, and generally speaking, when we approach the conversation with clients, there's a general structure that we'll start from and make tweaks from there. But a typical syndication structure um, is going to include a syndication entity or an investment vehicle, right, where all the investors pool their capital into, and that's typically known as the issuer entity. That's the entity that's selling securities. And I probably should back up a little bit and talk about what a security is, because a lot of our clients they're raising capital to go buy real estate, but sometimes they're not really quite sure how the securities piece fits in. Like, why does the SEC care about what I'm doing if I'm raising capital to go buy real estate? Well, at the end of the day, there is a landmark decision that was decided by the Supreme Court many decades ago, and out of it came this test that's called the Howey test. And so, out of that, the SEC does an analysis to determine if you are selling securities or not, and essentially boil down to the four main tenets of that Howey test are to determine whether something is a security or not is is an investor making an investment of money? And typically the answer is yes. Are they expecting some sort of return of profits? And usually the answer is yes. These next two elements of the test are usually the ones that are analyzed a little bit more closely and determine whether the client is actually selling securities or not. And one is whether the efforts are generated by someone other than the person who's making the investment, like some sort of promoter, or in the space we call a sponsor, right? So typically in these deals, a sponsor, right, or a GP, right? People use that term quite often, is raising the capital from investors. The investors are passive in the deal. They're not doing anything actively towards managing the investment. And in fact, it's sold to them as a passive investment. And that's what's going to be considered the efforts of a third party, right? So that's the promoter. And then the fourth thing is a common enterprise, is if the investors are pooling together capital through the efforts of the GP in order to buy some sort of underlying investments, right? And at the end of the day, for us, that's typically going to be real estate. For most of our clients, is those are the two main things that are going to move it over from something that's active, right, where you may have some sort of joint venture or other arrangement between partners, to a passive investment for investors. And so the SEC is going to look at that as securities. And so you have a couple options. Our founder always liked to say you have three options. One, you can register your offering, right? Think of, IPO. Generally, that's going to cost seven figures, right? That's going to take multiple years, and that's a huge process, right, for companies that are going public. And so most of our clients do not play in that space. The second option is to find some sort of exemption, or three, it's an illegal securities offering. So, as you might imagine, most of our clients fit into that second category. We play in the exemption world. The SEC offers exemptions to sponsors who are raising capital that allow them to do so without having to register their securities offering, but there are very strict rules that they do have to follow. So I say that to get back to the question about a typical entity structure. So the issuer of the securities is the entity that's selling the securities to the investors, like we just talked about a minute ago. That might be an LLC, a limited partnership, or sometimes other investment vehicle. And typically we will have the client form a fund manager or a syndication manager. That's a legal entity. So that may be another LLC or limited partnership, corporation, or other entity to manage that syndication. And that's usually for liability protection, is that entity is calling all the shots. It's managing the syndication. It's deciding what assets the syndication is going to purchase. And it's going to make decisions about how to operate those things in terms of the assets and when to dispose of them. All of those decisions are made by the syndication manager. And then typically, another entity for the sponsors where they're going to collect their carried interest or their promote or sweat equity. And typically the investors will invest together in a class of membership, a passive class of membership that will entitle them to a certain percentage of ownership of the company or preferred return, depending on what the structure of the syndication is. So sorry, I know that's a long answer, but that's sort of the background into the entity organization and why we're dealing with securities here.
No, that makes sense. Appreciate it. So to put it simply, um, let's talk about what goes on top and who owns what, and where does the investor money goes, and where does the management piece goes, if you don't mind, just so
Yeah.
people can have a visual while they're listening to it, and we can also post a picture on the blog post of this structure so they can see what it looks like.
Yeah, absolutely. I think the picture will really help, and we can help facilitate that. But so your syndication LLC, that's where the investor money is going to go into, and like we said, that's the issuer entity. That's the entity that is selling the investments to the investors, and so all that capital is going to get pooled into that entity, and that entity will go out and purchase the underlying asset. And so that's the flow of money from the investors into the syndication LLC into the underlying asset. And from there, that underlying asset will hopefully generate some sort of cash flow, right? Or some sort of profits from, depending on what the underlying strategy is, that then flow back up to that syndication LLC. And then there will be an operating agreement for that syndication LLC to describe how those profits get distributed between the sponsor or the GP and the investors that are normally called the LPs. And so that'll be dictated in that agreement from that syndication LLC. Now, we talked about the manager LLC earlier. The manager LLC is going to be the entity that decides how to manage and operate that syndication. And so that's going to be a separate LLC. Um, and that LLC is generally going to collect management fees. So in a real estate syndication, it may collect an acquisition fee when the property is purchased. It's probably going to collect an asset management fee, typically around 2%. Maybe it'll be less, 1%, 3%, depending on what type of syndication it is, and also disposition fees. So when the property is sold, it'll collect a percentage of the sale price. Or if it's a refinance and a longer term hold, then there may be a certain fee on the refinance on the new loan amount. And so that manager LLC will collect those fees in exchange for providing those services to the syndication. If you think about it, if these individual investors, were to buy their own properties and go out and buy, rental real estate or, some other asset, that's all work that they're going to have to be doing on their own. They're going to have to be, handling the acquisitions, right? Finding the deals, negotiating them, closing on them, and then being their own asset manager, right? And organizing all of that, whether it's, renovations and capital expenditures or managing the property manager. There's lots of work that has to be done there. And then same thing in terms of dispositions. The manager has to decide, when the ideal time is to sell the property, right? Same as an individual investor. So in exchange for making those decisions and doing all of that work yourself, you're giving that up to the manager as an investor, and you're hopefully happily paying those fees to the manager to be able to provide those services while you collect your profits through cash flow and ultimate disposition of the asset at the end of the day.
Yep. It's more than a full-time job, as you can imagine, the due diligence
Yeah,
and, not all deals go through, and there are a lot of expenses related to these deals up until the due diligence period. So there's a lot that goes on behind the scenes. You mentioned that, funds are becoming more popular right now. Can we talk a little bit about funds versus syndications, and why are people
sure.
more interested in that in this market?
Yeah, absolutely. So there's definitely advantages and disadvantages to each, but I'll start by talking about how we typically explain the difference between a syndication and fund, because I know people use different terms, and the meanings that we ascribe to those terms do matter. So, typically, when we refer to a syndication, it's something that's project specific. So, a GP is raising capital to go buy a specific asset that they've disclosed, or maybe it's a group of assets, so it's a portfolio. Um, but the key is those are defined assets that the investors know what their capital is going towards in terms of the investment. Um, a fund at the end of the day, generally speaking, most funds are going to be blind pool funds. In other words, the GP is setting up a fund and setting up criteria for the types of assets that they plan on purchasing. And so the investors receive that disclosure and they receive, if you will, the buy box for the fund on the types of if it's in the real estate space, maybe it's the types of real estate assets, maybe it's the geographical locations, maybe it's certain types of real estate strategies that they're going to pursue. And they put that all together in their disclosure documents and their operating agreement. And the investors are really betting on the GP's ability to execute on that business plan and that they're trusting that GP to go out and find deals that fit that criteria that are going to be able to generate returns for the investors. Um, I'd say one of the biggest pros with a syndication is a lot of investors like to see, feel, touch the dirt, so to speak. And so a syndication allows them to see that. They can see the underwriting as it relates to a specific property, and they can become more comfortable if it's an asset that they can then go sort of underwrite on their own to a limited extent, not to the same extent as the GP, but that does. I think give a certain comfort level to investors versus a blind pool fund, which is a little bit more difficult because investors are really betting on the GP to go and find those deals. Some investors don't feel as comfortable with that. Sometimes with newer GPs, it can be difficult to raise in a blind pool or a situation where maybe you're onboarding new investors. That can be a difficult sell. So sometimes being able to do syndications and have a track record with clients better suits you to do a fund in the future. Or I will say we have some clients that have great track records, but because of the way that they operate their syndication businesses, it makes a lot more sense for them to syndicate as opposed to a blind pool fund. So. But one of the advantages I would say of a blind pool fund is it does give you the ability to not be scrambling every time you have a closing, right? So when you do a syndication, typically clients don't have a lot of time to do that, right? So once they have their
Yeah.
LOI out there, they get it accepted, they're negotiating the PSA, things can happen very, very quick. And so they may have a matter of 2, 3, 4 weeks to raise capital. In some cases, it might be a few hundred thousand. In other cases, it may be a few $1 million. And so that could be a very stressful time for a lot of GPs, especially as they start to hit deadlines in the PSA for refundable versus non-refundable earnest money, and their money goes hard. So that can be a challenge. Whereas with the blind pool, it allows you to not have to deal with that stress if you're able to pre-raise for properties and have, as it were, the money in the bank when it comes time to close.
On that note, well, first, what is a typical fund set of fees? And also, what if, let's say, the fund they commit a certain amount? Is it standard that they just put, let's say, 10 or 20% of their commitment, and then when we find the deal, that's when they have to give the remainder of their commitment? Is that standard? What is
Yeah.
standard?
That's a good question. Yeah, what's pretty standard is a capital call structure, as you were alluding to, where the investors will typically put down a percentage of their capital commitments, and they will likely sign a subscription agreement, agreeing to commit, let's say, $100,000 to a fund. And as the GP has underlying assets to purchase, they may call that capital in portions over time. So in order to bind them to the fund, the sponsor will usually take a 10, 15, maybe 20% deposit on that total commitment. So the GP may take, let's say, 20,000 as a deposit. Um, and then as they have additional assets to purchase, they may call additional percentages of that capital. And so the investor is committing to put in that capital and agreeing to put in additional capital when it's called by the GP. And there may be clauses where the investor may forfeit a deposit if they fail to put up additional capital to meet their original commitment. And so GPs will usually do that so they're not sitting on a bunch of cash before they have the deal flow to be able to deploy those monies.
Sure.
But it depends on the structure. We do also have some clients that will raise all the capital up front because they do have the deal flow and they know that the timing will be pretty short in between when they receive those funds and when they deploy them. But it also
Got it.
depends on the type of structure in the fund, whether you have a preferred return or whether there's just a profit split from cash flow and distributions, and also net profits from a sale event.
Got it. And so, what is a typical fee for the fund, like a management fee, and also are there other fees that are typical for funds?
Yeah, so most of the same fees apply in a syndication versus a fund. Biggest difference being an asset management fee at the fund level. That may be usually it's a smaller amount. It could be a 0.5% or a percentage point or 1.5%, depending on the size of the fund and the type of work involved in the fund on the assets under management, or sometimes it's on the capital that's deployed. There's a lot of different metrics that fund managers may use, but usually it's on assets under management. In a typical private equity structure, that's usually 2%. And so that can be the case. It usually can go up to 2% in a real estate fund as well. But then your acquisition fees, disposition fees, refinance fees, are usually going to still apply at the property level.
Got it. So, very similar to syndication then.
That's right.
Jonathan, we have so much to talk about, but unfortunately, we have to stop at least this first interview. So hopefully, we'll have you back, to talk about many other topics that we have here. But how can our listeners get in touch with you?
Sure. Yeah, absolutely. They can go to our website at premierlawgroup.com, or feel free to email me at jonathan@plglp.com, or I'm happy to field any phone calls from those who may want to reach out. My cell's 508-212-1193.
And also, you guys are doing some subscription models as well, right? For syndicators, for operators like us. Is that
That's
correct?
right.
Okay.
That's right. Yeah, we've built out various service options for syndicators at all sorts of different levels to help meet you where you are at.
Yeah, and they are wonderful. They have worked for us. So highly recommend Jonathan and the firm. Thank you so much, Jonathan. I really appreciate your time.
Thank you, Stephanie. Appreciate it.